So a lot of people say, well, what makes the Woolen mortgage team different? I'm not sure what if you know what a CMPS is. It's a certified mortgage planning specialist. It's an education, a course that I took about 10, 12 years ago. It's pretty extensive, and basically it basically tells you how to integrate the mortgage that the borrower select into their long and short-term financial goals. So I am not a loan officer. I do not want to be called a loan officer. I think that's a terrible, I don't know, name for what we do. We're in charge of the single largest debt that your customers go into, and it's the biggest investment that they've ever made. It's the largest asset they probably ever own, and life planning and goals and cash flow discussions need to go into that. So the CMPS, I mean, there's a lot that goes into it. All of the things that we have to, here's a breakdown of all the things we're taught on. How to increase cash flow, become debt-free sooner, and how to invest in real estate, how to save money on income and capital gains and estate taxes, how to improve credit score, setting up for retirement. I mean, I'm kind of going through this pretty quickly. Divorce situations, how to overcome those issues, how to finance children's education with offsetting accounts, financial care for elderly, job career changes. I mean, all of these things I think about when I'm talking mortgages. Start or sell your business, like a lot of people talking about their businesses and starting and selling. We discussed that and how that can impact their mortgage. Buying and building vacation homes, buying home refinancing mortgages, all of these things that we're pledged to follow a code of ethics that's different. So it's a lot different than just being a loan officer. Anyone can be a loan officer. Anyone can go get their license and be a loan officer, but they don't have the education behind how to use the mortgage as a financial tool. So I want to show you a little bit about what makes us different and how I use that to make you really look great. And I have some real life scenarios here, so I want to share those with you real fast. The real life scenario that I have here is, let's just say a borrower came to me, and these are actual scenarios that have happened to me in the last few months. So a borrower comes to me, he wanted a cash out refinance on a free and clear property. So he owns a property free and clear. The real estate agent said, call Sean, he'll tell you what to do. He'll get your refinance, he's great, yada, yada. We met face to face. He owns a lot that he wants to build a home on. The home he owns right now is free and clear. So he wanted to do a cash out refinance, pull about $400,000 out and use that money to build this new home, his new primary home that will be his primary in the future. Then once it's built, he's going to sell his other home and then move in. So the borrower asked me, what is the best rate that you can get me on this? So I basically told him, no, I'm not going to do a cash out refinance. And here's what I told him. And this is where I'm different. I'm more of an advisor. I'm more of a mortgage strategist. He wanted to pull a cash out. He wanted to pull $400,000 out right now. He wanted the best rate. He was shopping rate. And that's all he was really focused on because he wasn't guided in any direction. So here's my solution. I know that's cheesy, but oh, here we go. I told him not to do a mortgage. I said, actually, no. I'm not going to do your mortgage. I don't think you should do a cash out refinance. And because when you do a cash out refinance, you get that money right away. You get $400,000. It's going to sit in your account and you're going to pay that mortgage payment every month on that huge, big amount. And then I said, what you need is a free home equity line. You just need to get a free home equity line. They don't cost you a penny. That way you can have the money sitting there waiting for you when you need it. And you only pay interest on the money you use. So now he's only paying interest on the money he uses because he's probably not going to be using that money for 3 to 4 or 5 months because he's getting through the planning stage. He's getting the architect involved. He's paying them a little bit. And then he just uses that as a checkbook. And then once that house is done, he sells that home and that home equity line gets paid off through the sale. The savings that he was going to have on this was massive. I mean, we're talking $20,000, $30,000, $40,000 in savings minimum by going that route. And I could have made a commission on that. I could have done a mortgage, but because of the code of ethics that we're held to on the CMPS system, I have to, and that's just how I'm built, I have to tell him what's best for him. So he walked out with a different plan. Nobody had talked to him about this. He had talked to numerous mortgage persons, and none of them had told him this. So I'm going to make you look good, because now they're going to say, wow, I'm so glad that that agent referred me, because now look what I saved, tons and tons of money. And it was just a fantastic outcome. Here's another one that we had. A transfer from California, buying a home in Mesa. He's buying a new home, and then he's going to be selling his California home later in the future, once they did updates to the property, spruced it up, painted it, and then once that house sold, he was going to be using those proceeds just to pay off the mortgage. So the borrower said, what's your best rate? I mean, that's what almost every single person tells me. What is the best rate? And he was banking with Bank of America, and Bank of America's rate was pretty good. So we were similar. But I told him, I'm like, listen, if you're only going to have this house for 6 to 12 months, why don't we get a higher rate and pay off all of your closing costs? So you save, and in this scenario, it was $8,250 in total closing costs between title, escrow, everything. His payment was $185 a month higher. But with that higher rate, I was able to get him a credit to pay closing costs. Now, that credit to pay closing costs would cost him about $2,200 over a 12-month period. So the net savings to him was $6,000. And now he's excited that I told him a better strategy. Instead of being focused on rate, he is now educated on how it works. And he's going to save about $6,000 over that scenario. Again, solutions, right? We aren't looking for best rate. Sometimes we are, but sometimes it's all about their goals and what they're looking to do. So when you refer your customers, we're not just going to be giving them an answer to their questions, because sometimes, well, they don't know what I know. They don't know how to use that mortgage. They don't know all the tricks. So a lot of times when people go to a lender, they're order takers. They say, I need a 30-year fixed and I need the best rate and I want to buy down the rate and this is what I need. But the questions aren't being asked.